If you're over 70 and a half and giving money to charity, there's a tax strategy that could save you thousands of dollars, and most retirees don't understand it. It's called a Qualified Charitable Distribution, or QCD. And in this video, I'll explain what a QCD is, who qualifies, how it works, and the biggest mistakes to avoid. For those of you new here, my name is Jaco Jordaan. I'm a certified financial planner with Riverchase Wealth Management, and we help individuals and couples prepare for retirement with a focus on tax-efficient retirement distributions and long-term planning. Let's get into it. So first, what is a QCD? A Qualified Charitable Distribution, or a QCD, lets you donate money directly from your IRA to a qualified charity. The key benefit, that money can count towards your required minimum distribution, or RMD, without being included in your taxable income. And that's the part people love. So here's what's normally happening. You take a distribution from your IRA and it goes to your checking account. You then cut a separate check to charity and you feel pretty good about yourself. But when you withdraw money from a traditional IRA, it's fully taxable as ordinary income. And you probably don't get qualified to itemize the charitable deduction. So you get taxed on the income and you don't get to benefit from the deduction. But with a QCD, the money goes straight from an IRA custodian to the charity, and it gets excluded not just from your taxable income, but importantly, also from your adjusted gross income, or AGI. And I'll discuss the importance of that in a second. For now, just focus on this. Instead of taking the money, paying taxes, then donating what's left, a QCD allows you to skip the tax hit altogether. So who can use a QCD? As with most great tax benefits, the IRS restricts who can use the benefit. Not just anyone can do this. To qualify, rule number 1, you must be at least 70 and a half years old. Now, you may know that the RMD starting age was pushed up to the age of 73 by the Secure Act and will eventually rise to 75 under the Secure Act 2.0. However, I don't know if this is intentional by Congress or simply sloppy drafting, but the RMD age used to be 70 and a half, and that remnant survives for QCD eligibility. So if you're over 70 and a half, you can use this strategy. Rule number 2, the money must come from an eligible IRA. Now, there's lots of other tax-deferred investments, with most common ones being a 401k or a 403b. And while the tax treatment generally is very similar for an IRA in one of these plans, note that for QCD purposes, it must be an IRA. Distributions from 401ks or other qualified plans are not eligible for QCD treatment. That means if you have a 401k and you want to take advantage of this strategy, you'll first have to roll the assets to an IRA. Then you can take advantage of making QCDs from the IRA. I do want to touch briefly on inherited IRAs as well. Under the Secure Act, the typical treatment of an inherited IRA is taking RMDs for 9 years and then completely emptying the account as a final RMD in year 10 following the death of the original owner. Since there are RMDs, you might think you can do a QCD, and you would be right, but there's a catch. Remember rule number 1 above, right? Being 70 and a half. Now, you can own an inherited IRA at age 40 and have an RMD requirement. You would not be eligible to make a QCD. But once you're over 70 and a half, those distributions are eligible for QCD treatment. Rule number 3, the funds must go directly to a qualified public charity. More specifically, the qualifying charity must be a public 501c3 organization. Now, many philanthropic families may have set up a donor-advised fund or a private foundation, and it's important to note that a QCD cannot go directly to a DAF or a private foundation, or for that matter, to other entities like charitable remainder trusts or charity-adjacent entities which are not 501c3s. Most charities will state on their website that they are a 501c3 organization, so it's pretty easy to check the box on this one. Okay, rule number 4 regards the maximum QCD that can be given. Today, RMDs kick in at age 73, and for many higher net worth couples, the RMD exceeds what they need to live on, so it's just extra taxable income. For those who are charitably inclined, and particularly for those who have substantial non-IRA assets, QCDs can satisfy all or part of the requirement. In 2026, the maximum QCD is $111,000 per person, adding to $222,000 per couple. So if you are fortunate enough that your combined RMD is $300,000, you can only give away $111,000 per person for a total of $222,000 using the QCD rules. Note as well that the QCD is not limited to your actual RMD. So if you have an RMD of $5,000, you can give away $10,000 as a QCD. In fact, you can give up to $111,000 and get the QCD treatment if you really wanted to. Now let's get back to the tax treatment and highlight why QCDs are such a great tool. As I said earlier, versus taking a distribution and then trying to take an itemized deduction, a QCD never hits your tax return. That means it's also excluded from your adjusted gross income or AGI. AGI, in turn, is used in various phase-out calculations on a variety of tax or stealth taxes. For example, the exclusion from AGI potentially means lower combined income. Now, for most couples, combined income is the sum of your AGI and one half of your Social Security benefits, and is the basis for determining how much of your Social Security is taxable. A high combined income can result in as much as 85% of your retirement benefit being taxable, and for some couples, reducing AGI by $1,000 could mean further reducing taxable Social Security. AGI is also used to determine IRMAA surcharges for your Medicare Part B and D premiums. First, what is IRMAA? Well, if you're 65 or older and you've applied for Medicare, you know that you pay a monthly premium for your Part B and D coverage. Currently, that's about $203 for Part B. For higher income couples, Medicare adds an income-related monthly adjustment amount, or IRMAA, above certain income ranges, which can add $81 to $486 per person per month in incremental costs. So if you're close to an IRMAA threshold, making a charitable contribution via QCD versus distributing from an IRA and then making a charitable contribution could tip you under the IRMAA threshold. So for example, let's say you're a married couple with AGI of $270,000 and you're thinking about a $5,000 contribution to charity. If you distribute $5,000 from the IRA and then make that contribution, your AGI goes up to $275,000. Now, the second IRMAA threshold in 2026 is $274,000, above which your Part B premium goes up by $203 per month per person, which is an annual cost increase of nearly $5,000 for a married couple. In this example, that's roughly what you plan to give to charity in the first place. If you did your contribution via QCD, your AGI stays at $270,000, you stay under the IRMAA limit, and you avoid the additional premium increase. Doesn't that sound like a better deal? There's a variety of other AGI-based tax provisions which could be impacted, including net investment income tax, which is a 3.8% surtax on capital gains and other investment income, which kicks in at $250,000 in AGI for couples or $200,000 for individuals. Another one is the new enhanced senior deduction created by the One Big Beautiful Bill Act. That provision provides $6,000 in additional deductions for seniors over 65, but it's phased out based on, you guessed it, AGI. The phase-out range is $150,000 to $250,000 for married couples and $75,000 to $175,000 for single individuals. So you see, QCDs can make a potentially significant difference in your AGI and ultimate tax bill. Beyond the AGI reduction, realize that many retirees simply no longer itemize deductions. Now, this results from changes through the Tax Cuts and Jobs Act of 2017, which effectively doubled the standard deduction. And for 2026, the standard deduction is $32,200 for a married couple, and you can add to that the $1,650 per person additional standard deduction for seniors over 65, and then that total standard deduction bumps to $35,500 for a senior couple. In order to itemize your charitable deduction, the total of your charitable donations, plus property tax, state income tax, and mortgage interest, which are the most common itemized deductions, needs to add up to more than $35,500. And for most senior couples, that's not happening because the mortgage is paid off, various retirement income sources are excluded from state taxation, so your state taxes are lower, and as a result, they're not getting close to the itemized limit. So for many, if they distribute from the IRA and then make a charitable donation, there is no tax benefit, all because they cannot itemize. Now, I should mention that under the OBBBA, starting in 2026, there is an available $1,000 per person non-itemized charitable deduction for donations. That means as a married couple, you can deduct $2,000 of cash donations to a charity in 2026 without itemizing. However, while that will reduce your taxable income, it will not reduce your adjusted gross income. And as I've discussed before, if you're near an AGI threshold, even $2,000 could potentially make a difference. So, to reiterate, if you distribute to your checking account and then write a normal check to charity, you might not receive any tax benefit at all, whereas a QCD will allow you to receive a tax benefit even if you don't itemize. That's huge. All right, so let's talk about some of the most common mistakes with QCDs, and I've already alluded to a lot of these. Mistake number 1, taking the money personally first. Remember, the funds must go directly from the IRA custodian to the charity. If the money hits your bank account first, it does not qualify. Mistake number 2, using the wrong type of account. Remember, QCDs have to come from an IRA, not an active 401k. Mistake number 3, sending money to non-qualified organizations. While donor-advised funds and private foundations do qualify for itemized charitable deductions, they do not qualify for QCD treatment. So always verify that the charity is an eligible 501c3 public charity. Mistake number 4, waiting until late December. So here's where IRS deadlines meet some practical limitations. The IRS requirement is that the check has to be cashed by December 31. However, custodians get very backed up at the year end, and they'll often set an administrative deadline, which may be as early as late November, in order to guarantee processing completion by December 31. So start early if you want that QCD counted for the tax year. Now, those are all pretty straightforward mistakes to avoid. However, the absolute biggest mistake that I see on QCDs regards reporting the QCD on your tax return. So when you take a distribution from an IRA, the custodian is going to report that distribution on what's known as a Form 1099-R. The gross amount is going to go in box 1, taxable amount is going to go in box 2. Surprisingly, current regulations do not provide for reporting of the QCD on the 1099-R. So let's say you had a $30,000 RMD and you took $25,000, that went to your checking account. $5,000 went as a QCD and it followed all the rules. It went direct. Charity was a 501c3, and you're obviously over 70 and a half because you had an RMD requirement. So you would think the 1099-R would reflect a gross distribution of $30,000 and a taxable distribution of $25,000 to account for the QCD. But the 1099-R will show $30,000 for both the gross and the taxable amount. There is no record of the QCD as part of that reporting. It is incumbent upon the taxpayer to remember that they made a QCD in the first place, and then to reduce the taxable distribution with a notation that the difference is due to QCD. Again, it's your responsibility to remember to do this, and if you're having your taxes professionally prepared, you need to let your preparer know that you made a QCD, because they're going to get the info on the 1099-R, and they're not going to know that you made a QCD unless you let them know about it. How do you actually do a QCD? Well, the process is pretty straightforward. Contact your IRA custodian and request a Qualified Charitable Distribution form. Choose the charity and the amount, and then make sure the payment goes directly to charity. Keep records for tax reporting. Remember, this does not go on the 1099, so you have to keep the reporting, and make sure that you let your CPA or tax professional know if you're using somebody to prepare your taxes. Qualified charitable distributions can be one of the most tax-efficient ways for retirees to give to charity. If you're already making charitable donations and taking IRA withdrawals, this is definitely a strategy worth understanding. If you found this helpful, hit the like button and subscribe for more retirement and tax planning videos. If you want to find out more about Riverchase Wealth Management, I'll add a link to schedule an introductory call in the description below. Thank you.